December 3rd, 2024, a date that will be remembered in financial history. On this ordinary Tuesday, something extraordinary happened. JPMorgan Chase, America's largest bank, a pillar of Wall Street, an institution that survived 2008, received delivery notices for 5.2 million ounces of physical silver. These weren't requests. These were demands, and they couldn't be rolled over, cash settled, or ignored. For 15 years, JPMorgan has been running what might be the largest commodity manipulation scheme in modern history. They've paid nearly $1 billion in fines, settled with regulators, and promised to reform, but they never stopped. Until now. Because the mathematics have finally turned against them. This isn't just another scandal. This is a countdown to a financial detonation, and the timer is running. Welcome to the story of how America's most powerful bank painted itself into a corner worth potentially $50 billion. A corner with no exit. Let me explain how we got here, and why what happens next could shake the entire financial system. The entire COMEX silver market operates on one fundamental assumption, that most traders will take cash, not physical metal. Historically, 95% of silver futures settle in cash. That means for every 100 contracts promising silver delivery, only 5 actually demand the physical metal. The other 95 just take their profits and disappear. This created a perfect scenario for banks. You could sell 100 paper claims backed by just 5 ounces of silver sitting in a vault. Think of it like a coat check at a theater. You hand out 100 tickets, but you only have 5 coats. It works perfectly until everyone shows up at once demanding their coat. As long as only 5% demanded delivery, the system worked flawlessly. JPMorgan didn't just participate in this game, they dominated it. From 2010 to 2020, they became the largest vault operator on COMEX, giving them complete control over deliveries. When someone demanded metal, JPMorgan could shuffle inventory between different vault categories to create the appearance of ample supply. But before we go further, you need to understand why JPMorgan got so deep into silver. This isn't just about greed, it's about control. In June 2021, Basel III banking regulations were implemented globally. These new rules fundamentally changed how banks treat precious metals. They reclassified paper claims, not backed by specific, earmarked physical metal, as lower quality assets. In plain English, banks could no longer treat paper silver promises as high quality assets. The fractional reserve game was officially over. JPMorgan had 2 choices: close their massive short positions or acquire hundreds of millions of ounces of physical silver to back them. They chose neither. They gambled that the old system would continue. That gamble is now exploding in their face. And then silver hit $59 per ounce. What's so special about $59? At 58, the market behaves normally. At 59, everything changes. It's like water at 99 degrees versus 100 degrees. 1 degree makes it boil. $59 is the boiling point, and it triggered a cascade of pressures JPMorgan cannot control. First, mining economics shifted. At these prices, major mining companies stopped selling to COMEX. Warehouses, where prices had been suppressed, and started selling directly to industrial buyers at a premium. The supply pipeline to COMEX dried up overnight. Second, China created a vacuum. Silver was trading at the equivalent of $62 an ounce on the Shanghai Gold Exchange. Traders immediately started moving COMEX silver eastward, chasing the profit. Third, industrial panic buying accelerated. Solar panel manufacturers, electronics companies, and electric vehicle producers all need silver. They started demanding physical delivery, not paper promises. 3 simultaneous pressures, all converging on JPMorgan's vault. Here's where the mathematics become absolutely brutal. Between 2008 and 2020, JPMorgan amassed a staggering 947 million ounces in paper short positions. Nearly 1 billion ounces. It worked perfectly until Basel III changed the rules. Now, those shorts need physical backing. But here's the problem. COMEX vault inventory has collapsed, from 47 million ounces in 2023 to just 8.9 million ounces today. That's an 81% decline in under 2 years. Let me put this in perspective. COMEX registered inventory, the silver actually available for immediate delivery, stands at just 28 million ounces. At the current delivery rate, that's enough for exactly 8.4 days. Imagine a vault with 28 million ounces of silver inside. Now imagine 862 million paper promises all claiming rights to that same vault. That's 30 paper claims for every physical ounce. That's JPMorgan's situation. The December 3rd delivery notice for 5.2 million ounces is just the beginning. And this time, we have irrefutable proof. In 2020, JPMorgan paid $920 million, the largest precious metals manipulation fine in United States history. They admitted guilt, promised reform, paid the fine, and kept their short positions intact. Why? Because they assumed the paper game would last forever. That assumption just died. For the first time since 2008, JPMorgan's silver short positions have dropped below 15,000 contracts. Not by choice. They're being forced to close them because of physical delivery demands they cannot meet. The paper game is over. Think this hasn't happened before? In 1980, the Hunt brothers tried to corner the silver market. Regulators simply changed the rules mid-game and destroyed them. But today's situation is far more dangerous. The current pressure involves 14 times more paper claims than the Hunt brothers' position. And regulators can't just rewrite the rules this time. Why? Because Basel III is international banking law. It supersedes any single exchange's rules. No one regulator can waive these requirements without triggering a global banking crisis. JPMorgan is trapped. And when this trap finally springs, did you hear? JPMorgan just got caught in a trap worth billions and there's no escape hatch. The evidence is hiding in plain sight, and it suggests they are trapped by a scheme they built themselves. But before I show you the smoking gun, you have to understand this. When a bank starts moving this much money, this quickly, they aren't just rebalancing. They are panicking. JPMorgan's latest SEC filings reveal something extraordinary. In a single quarter, they slashed their precious metals derivatives exposure by a staggering $14.7 billion. At the same time, their physical precious metals holdings shot up by 2,100 tons. This isn't just business as usual. This is a 5-alarm fire drill. Even more telling is what's buried in their legal disclaimers. They now explicitly warn that physical delivery demands might exceed their available inventory during market stress. That's not a disclaimer. That's a confession. They're basically telling you, we might not be able to deliver the silver we promised. Their 14-year manipulation game isn't ending because they suddenly grew a conscience. It's ending because the math makes it impossible to continue. They built the trap, they walked right into it, and now they're scrambling while the whole market watches. And the math behind this end game is brutal. Let me show you the numbers that prove this isn't just speculation, it's a mathematical certainty. The COMEX currently has about 28.4 million ounces of silver registered and available for immediate delivery. But here's the kicker. There are 862 million ounces worth of paper claims on that silver. That's roughly 30 paper claims for every single physical ounce in the system. Historically, this system worked because only about 5% of contracts ever demanded physical delivery. But here's the breaking point. If just 3.5% of current contracts demand their silver, it would wipe out the entire registered inventory. We'd enter a deficit, and the system would break. At the current delivery rate, all registered silver will be gone by May 2025. If that rate accelerates, which is very possible, the inventory could be gone by March or April. We're talking just 4 or 5 months from now. So, can new supply save them? Let's do the math again. Industrial demand for silver in 2025 is projected at 642 million ounces. Solar panels alone will need 247 million of those, and that number is growing 15% every year as we push for green energy. Global mine supply is only about 843 million ounces annually. After you subtract industrial demand, there's only 201 million ounces left for everything else. Just 5 years ago, that buffer was 340 million ounces. It has shrunk by 41%, the safety net has vanished, new mines take years to develop, and existing ones are already at max capacity. There's no emergency supply coming. So, what happens to the price when one of the world's biggest banks to deliver a commodity it promised to hundreds of millions of contracts? History gives us clues, but the math gives us a range. In a conservative scenario, we could see silver hit $120 to $150 an ounce. A moderate scenario, based on the inflation-adjusted peak from 1980, puts it at $200 to $250. And in a vertical spike scenario, where industrial panic buying meets investment demand, silver could surge to $350 per ounce. The timeline for this? Q2 to Q3 of 2025, possibly even sooner. This isn't like other market squeezes. We're not talking about speculators. We're talking about the largest bank in America, trapped by its own scheme, facing real delivery demands from industrial buyers who need this metal. Silver is irreplaceable in solar panels, electronics, and electric vehicles. This isn't about beanie babies. It's a critical industrial metal with shrinking supply. What happens if JPMorgan can't deliver? The shockwaves will be felt everywhere. Pension funds, electronics manufacturers, and the entire green energy transition will be impacted. Solar panels, EVs, and smartphones will all get more expensive. And here's the final twist. Governments can't just regulate their way out of this. To solve the problem, they either have to let a systemically important bank fail, which is unthinkable, or find hundreds of millions of ounces of silver that simply don't exist. For once, a bank that seemed untouchable is genuinely trapped. The countdown has begun. This is not a prediction. It's mathematical inevitability playing out in real time. The question isn't if this blows up, but when and how big the explosion will be. Welcome to what could be the greatest commodity crisis of our time. Thanks for watching, and make sure to subscribe for more updates on this story.